South Africa, we expect the impact to be about an increase of 20 to 30% of the reserves, which means about 50 basis points of the capital ratios. Nigeria and Kenya, we can't answer the question because the bank can't answer the question. It's too early. So they are working on it. They speak to the regulator, but it's too early to comment. And in the GCC, it's nearly a positive impact. I mean, these banks have been over-provided for many years, especially in Kuwait. So the question is more, how will they use excess reserve and where will they go? And they will end up going some sort of capital reserve, but we don't know exactly where on the balance sheet. But there is no need to write new provisions. It's more excess already, excess provisions.
Ambreesh?
So just to respond in the context of Asia, it's a mixed bag. It's a very diverse market. So based on, first point is that I don't think very many banks have done sufficient work at this point in time to give very precise answers. We have been doing a survey with various banks in different countries and hope to publish a report as well. But our preliminary findings are that in certain markets, I think Singapore, Hong Kong, and Korea, where in the run-up to this transition, currently they have some sort of a transitional arrangement for a number of years, and therefore they have been allocating some general provisions or reserves, and we understand that that in part would be used to mitigate the impact of the expected loss computations that they will have to do. And again, no consistent answers. Some people would say maybe we would even have reversals as a result of that, or at the very least, we don't expect too much increase in terms of on a going forward basis. The story is very different on many sort of lower, less developed countries, emerging markets. For example, in India, I know that they are already grappling with the existing sort of hole in the balance sheet. And even though I understand their timeline is 2018, which is yet not clear whether they would sort of implement that or just push it down the line for a few years. I think chances are that's what they would do. In other markets also, we get the sense, as Eric alluded to, that there will be an increase, whether it will be 30-odd%, whether it'll be less, whether it be higher. Those exact computations have not been done. The good thing is profitability in many of these pre-impairment profits are pretty good. So even though there may be an increase, we believe that that in itself should not necessarily alter the fundamental sort of strength of these banks. So that's the sort of preliminary assessment that we have done so far.
I would say Latin America, it's perhaps too early to tell. Most of the regulators are still addressing how to tackle this. So when we are serving the banks, we still get like very broad answers. But I could say that intuitively, it wouldn't be surprising that the effects in terms of IFRS 9 might be very low, so even marginal, because and I think that one of the reasons for that is I was telling earlier that, for example, in certain countries we have had relatively weak regulatory frameworks in terms of capital definition, but I would say the opposite is true when it comes to asset quality. So we have had most regulators being relatively careful or cautious enough in terms of the definition of impairments, and in more especially when it comes to the required loan loss provisions. So virtually like internal models are fairly uncommon in Latin America, so we might see that the bar is already relatively high, so that I think it's very likely that the effect is going to be marginal, if any.
And again, last but not least.
So, I mean, in Russia, banks have so much flexibility in terms of how they report their asset quality anyway, especially in IFRS accounts, which are not subject to regulatory review, that I think implementation of IFRS 9 is not critically going to move the needle. I mean, Sberbank, I think, is expecting a moderate, I think 40, 50 bips, they've said, increase or decrease, I should say, in capital ratios. We're surveying other banks, and generally the sense is, yeah, a small reduction. In Turkey, we might see something similar, although in Turkey, banks do have these general reserves, which they've been rather slow to reduce in the expectation that partly they're going to have to create these additional reserves anyway for IFRS 9, so maybe we'll see an offset there, which will mean there won't be a big hit to capital.
Great.